everyone, and very warm welcome to everyone here. I hope you all are fine and doing good. And also, I am hoping that I am visible, my audio, I am audible, and also my screen is visible to all of you. So kindly confirm that everything is okay. In today's class, what is the basic motive of today's class? Here in today's class, we are going to cover all the module A with the help of MCQs. We will see different types of MCQs related to different concepts, and with the help of these MCQs, we will brush up our concepts. And I am assuring that I will cover here all the MCQs related to module A. All MCQs which are important for your exam. And in upcoming days, we will cover module B, we will cover module C, and then next day we will cover module D. And then we will see all the questions, all the important case studies, numericals of BFM in our class. And after that, final marathon will be there. That final marathon basically divided into 2 days, and in first day we will cover the combination of module A and module D, and next day we will cover module B and module C. Okay, so I think 6 to 7 hours it will take, but everything I will try to cover which is important for your examination. So here I am hoping that everything is okay. Then we will start our class. And here, first thing for the today's class, difficult roads often lead to beautiful destination. I know this hard work will obviously results, a very good result will come. So difficult roads often lead to beautiful destinations. So the questions will be the mixture of all the chapters which are in our module A, that is international banking. You all have to give the reply, and also you have if you liking this session, kindly give the comment, and also do subscribe this channel, because this channel is completely dedicated to the English medium students who is English medium bankers. So yes, and I am lucky that I am the first one who is taking here the marathon of module A, international banking BFM. And yes, there is a myth that BFM is a very difficult subject. In all the exam of, if we see the all exams of CAIIB, we always listen that BFM is the toughest exam, but no. A proper strategy, a proper learning sources are there, so we will easily tackle this BFM subject. And I am assuring you that watch these sessions, watch the marathon session, you will definitely clear this exam. So starting with our first question here, that is forward rate. What is the formula basically? Here asked forward rate is equals to spot rate plus dash, then bracket, dash. So you have to tell by seeing all the option A, B, C, D, choose the correct option. Okay, so I am giving everyone 2 seconds for every question. See, if we talk about what is the meaning of this forward rate. Forward rate basically is the rate at which the currency can be exchanged. The currency can be exchanged for another at a future date. And it is based on the spot rate. Spot rate is the current exchange rate. And the relationship between the spot rate and the forward rate is basically influenced by the factors like interest rate differentials between the countries. The relationship basically here, just give me a second. Okay, now everything is fine. So I am where? I am telling you about the forward rate. What is the meaning of forward rate? Forward rate is the rate at which a currency can be exchanged or another at a future date, and it is based on the spot rate. And whatever the relationship between this spot rate and the forward rate is influenced by the factors like interest rate differentials between the countries. And if this forward rate is higher than the spot rate, it is referred as premium. And if the forward rate is lower than the spot rate, it is referred as the discount. Basically, the forward rate is either the spot rate plus a premium if the forward rate is higher, or the spot rate minus a discount, that means the forward rate is lower. So the correct relationship is here, forward rate is equals to spot rate plus premium minus discount. So the correct option here is matches, that is option B, that is premium minus discount, that is equals to the forward rate. So clear? What is the meaning of forward rate? When the forward rate is higher, what is the situation? And what we call when the forward rate is lower than the spot rate, then that is referred to a discount. Okay. Now, and I also need answer from everyone. Just try to make this session interactive. So everyone give the answers whenever you see the question in your screen. Next question. Foreign exchange markets. The question is based on the foreign exchange markets. Foreign exchange markets are the regional markets, domestic markets, global markets, and also we can say this is a localized exchange traded markets. Foreign exchange markets we call as FX markets or Forex markets. These are obviously global in nature, meaning they operate across the world. They operate across the world with not a specific physical location or centralized exchange. They involve trading of currencies between various types of participants. Participants can be banks, central banks, commercial banks, financial institutions, individuals. The Forex market is the largest and most liquid market in the world, which operates 24 hours a day across different time zones and the markets globally. If we talk about the regional market, Forex market are not confined to the specific regions but span across the globe. Domestic markets, Forex markets are not limited to any country's domestic market but are international in scope. Whereas this localized market, if we talk about the localized exchange trade markets, unlike securities which are traded on the specific exchanges, Forex markets are decentralized and operate over the counter without a centralized exchange. So the most accurate description is here option C, that is global markets. Understood? Which discount plus example, Pankaj sir, what you want? Which type of example you want? Discount plus example, I didn't get it. Okay. Now, what is the purpose of caution listing in EDPMS? Okay, so take this concept from here. What is this EDPMS? That is export data processing and monitoring system. Basically, this is a caution list which is used to track and monitor the exports. Specifically, those are related to goods and the software, but also identifies the entities that might be engaging in some type of suspicious or non-compliant activities. The system is a part of the government efforts, basically, which are ensure that exports are legitimate and exporters comply with the regulations, including the timely realizations of the export proceeds. Some of the key function of the caution list in the EDMPS include tracking the exporters who might have issues related to the proper documentation or fulfillment of export requirements. Also, it ensures the compliance with the Foreign Exchange Management Act, that is FEMA, and here we can say other trade regulations are also there with the FEMA, obviously, and it also monitors like the export of goods and the softwares from the India to ensure that transactions are legitimate, legal, and foreign exchange is being properly repatriated. So basically, what is the primary purpose of this caution listing in EDPMS is to monitor the export activities of goods and the software. So here we can say the option B is correct here, to monitor the export of goods and software in India. This is the purpose of caution list in EDPMS. The rate at which the quoting bank is ready to sell the currency is called, in the context of, wait, you have to give the answer of this question. Just give the answer of yeah. Okay, you need like numerical type question here. Pankaj said on basis of forward rate and exchange like discount rate, right? Okay, I will tell you about this also. We will take one example on forward rate and spot rate. Don't worry. And also, there is a particular class on that. All the numericals. In these classes, what is my strategy I am sharing here? I try to cover all the theory part in the modules, like class wise modules are discussing. Like module A, we will cover all the formulas, for all the theories. There is a particular class only for the numericals and for every type of examples which are related to your BFM. Okay, but we will take one example on this also. Don't worry. First discuss these questions. We will discuss these questions. Then I will obviously provide you the one example. Okay. So this is the answer you told, offer rate. Okay. In the context of foreign exchange, Forex trading, banks and financial institutions quote two types of rate. First one is bid rate, the rate at which the bank is willing to buy the currency. That is also called buying rate, and offer rate is also called as ask rate. The rate at which the bank is willing to sell the currency to you. So basically, when a country bank is ready to sell a currency, the rate it offers is called the offer rate. Understood? And here is bid rate I told you. TT buying rate, let's talk about the TT buying rate. Basically, this is the rate, we can say this is the rate basically refers at which the bank buys foreign currency or a telegraphic transfer or a wire transfer. And what is the meaning of this swap rate? This is the rate which is used in the currency swaps of financial transactions, where basically two parties are exchange the currencies for a specified period. So here the correct answer is option B, that is offer rate. So I hope now you know what is the meaning of bid rate, what is the meaning of offer rate, what is the meaning of TT buying rate, what is the meaning of swap rate. Understood? What is driving banks to accelerate their digital revolution? What is the driving banks to accelerate their digital revolution? Let's check the options here. Decreased regulations in the banking industry, minimum competition from new financial service providers, increased regulations and the competition from startups and internet giants, lack of interest from the customers in the digital banking. So let me tell, according to you, which answer is correct here. C. Okay, let's check. Basically, banks are accelerating their digital transformation due to several types of key factors, which includes like increased regulations. Basically, the banking industry is subject to a growing number of regulatory requirements, such as basically those are related to the data privacy, anti-money laundering standards, and also here know your customer, that is KYC. These regulations require banks to adopt more efficient, score and automated digital processes to stay compliant. And the competitions from the startups and the industry giants. Here like startups and tech giants like Google, Amazon, Apple and Facebook are offering some initiative financial services like digital payments, online lending. This type of things challenges the traditional banking models. Basically, this competition is forcing traditional banks to innovate and adopt digital technologies to retain customers and to stay relevant in our rapidly changing options. So we can say here option C is correct according to the question, that is here increased regulations and competitions from the startups and the internet giants. Option C is correct here. Understood? Now, next question. How are technologies impacting the barriers to entry in the banking industry? How our technologies are impacting the barriers to the entry in the banking industry? If we talk about the technologies basically significantly lowered the barriers to entry in the banking industry for the various reasons. First one is cost reduction. If we talk about the development of artificial intelligence and other technologies, cloud computing, that has drastically reduced the infrastructure cost which is required to set up the financial services. Startups are no longer need physical branches or legacy systems which are expensive to build and maintain, obviously. And also the key factor is here improved the accessibility, because means the digital platforms like mobile banking and online financial services, these are allows new entrants to provide the banking and financial services but with minimum physical instruments and also infrastructure, which makes it easier them to reach customers without needing a traditional brick or any type of startup. And also regulatory compliance, we can say that innovation and innovation is very important. Technologies like using of AI. As we know, in our daily life, we are also using the Google for everything. We are also using the like YouTube for our solution, whatever we want. In any field we need solution. So that, like that, these digital platforms, these banks also try to use these technologies for the betterment. So basically, this is the C option. Technologies have decreased the barriers to entry for the new financial service providers. Option B is correct. Okay. Next question, what is the overall effect of digitization on the profile of the banking industry? Read the option and try to give the answer. Okay, if we talk about here, what is the overall effect of digitization on the profile of banking industry? Basically, what is the effect of digitization on the banking industry? Digitization has a profound impact on the banking industry, a very great impact, which fundamentally changes how banks operate and how now banks delivers the services. First one, what are the changes? It increased the innovation. Obviously, now you can do the payment with the help of your mobile. You can scan any QR code for the internet banking, just for the payments. That is what, that is increased innovations. These innovations are implemented by the banks for the comfortableness of the customers. And also it enhanced the customer experiences through this type of things. Through digital platforms, banks can offer now 24 into 7 services, which provides the great convenience for the customers. Features like mobile apps, chatbots, online transactions have revolutionized the way how consumers interact with their banks. Cost efficiency, these digital solutions reduce the operational cost by automatic processes such as loan approvals, customer services, and the compliance, and also allowing banks to operate more efficiently. And also accessibility and the inclusivity, means this digitization has expanded some type of financial inclusion by enabling the access to the banking services in remote and understand the areas through mobile banking and some other type of digital tools. It also fosters the transactions. Obviously, it also fosters the transactions. So basically, we can say here, given options here, the correct option is, after reading the options correctly, here option C is correct. That is, digitization has transformed the profile of the banking industry and also increased the innovation. Option C is correct here. Okay, all the theory, all the PDFs of the classes you will get in the new Telegram channel, where you will get all the PDFs, and you need the explanation other than the PDF, right? You want to say this. Like you need the explanation other than the PDF. Just tell me, do you want to say this? Next question, which of the following is not the fundamental reason for determining the exchange rate? Which of the following is not the fundamental reason for determining the exchange rate? See, I will provide all the PDFs of your related topics and the related classes, and I will explain the other things also. Basically, these module wise marathons are related to the MCQs. In these classes, I will tell you the MCQs, and MCQs, those MCQs which are basically most important for your examination, and these MCQs are collected from the most reliable sources. Okay, and apart from this, when you will see the final marathon, you will see the explanation of every topic which is related to your concept. These MCQs are basically based that types of question will be come in your exams. So these things are basically for basically what is the reason behind this, to revise all of your concepts. Okay, and whatever you want help, any type of help, you can tell me. I will obviously help you in whatever way I can help. Okay. So which of the following is not a fundamental reason? Fundamental reason, interest rate is the fundamental reason, because interest rate, if the higher interest rates are there, they attract the foreign capital and also increases the demand for a currency, and it causes its value to appreciate. Okay. Conversely, lower interest rates can have the opposite effects. If we talk about this speculation, market participants, investors, traders, they speculate on the future currency movements, which are based on the factors like interest rate, economic performance, and the geopolitical events. If we talk about this balance of payments, this is the country's balance of payments, which includes like trade balances, capital flows, and the financial transfers. These are all playing an important role in determining the currency's value. If there is a surplus is in the condition when the exports are more than the country's currencies, which is leading to the appreciation, while a deficit can lead to depreciation. And while the political events like elections, changes in the government policies, geopolitical tensions, they all affect the exchange rate indirectly, but they are not a fundamental reason for determining the exchange rates. The exchange rate itself is influenced more directly by the economic factors like interest rates, inflation, balance of payments, rather than political issues. Even through political instability or politics can have impact an investor's confidence and the market behavior. So the correct option is here option 2, that is political issue. Okay. Next question. Valuation of foreign exchange profits and the losses by the dealers is carried on the basis of. Read the options, try to memorize whatever you learn. See, let's talk about FEDAI. FEDAI means this is the Foreign Exchange Dealer Association of India, which is responsible for setting the guidelines and the standards for the valuation of foreign exchange profits and the losses by the banks and the financial institutions in India. Now this USAP, what is this? This is Uniform Standard Account Procedures, which are prepared by the FEDAI. Basically, it outlines the accounting procedures for the valuation of foreign exchange transactions and whatever the profits and losses, which ensures the uniformity across the industry. And here this FEDAI USAP provides a consistent method for the banks to account for foreign exchange transactions, which includes the determination of profits and losses which arises from the currency fluctuations. So in this in the given options, you can say the correct option is FEDAI, Prepared Uniform Standard Account Procedure. So the option B is correct here. Understood? Yeah, I understand your concern, Hemant sir. You are saying that whatever you told in your courses, that PDF compilation you want, and also the explanation of that PDF, right? And the extra explanation if necessary in the concepts, right? You are saying that, I am saying that this module, this marathon, 4 days marathon are based on the MCQs and the numericals. And when the day of final marathon is there, which is on the I think 28th and 29th, you can see the schedule. On that day, I will explain everything. It will take 12 hours, not continuous 12 hours, 6 hours on the first day, 6 hours on the next day. I am assuring you that I will use that PDF and I will explain everything. That classes are based on the only theory explanation, because I will tell you all the numericals on particular one class which is dedicated only to the numericals and the case studies. These 4 days classes are related to the most important MCQs. Okay, now your doubt is clear, sir? And I will provide the PDF to you, all the PDFs, don't worry. Yes, obviously, these marathons are also important because this includes all the MCQs, all the most important MCQs and the concepts too. Yeah, you are beginner. Yes, you have to follow these marathons too, because in the exams you will face the MCQs and also the questions without the options. So obviously these marathons are important for you if you are a beginner. Most important, because when you will learn, okay, I got it, what are you saying. You are beginner and you are first time starting this subject. Yes, whenever you are going to read these things in depth, so you will have the idea that this thing I already learned in the marathons. These are basically, I am telling here the important concepts. Yeah, obviously you have to follow this marathon. All obviously this will be helpful for you. Don't worry. Okay. Now, bank may have foreign exchange surpluses from the following sources. Banks may have foreign exchange surpluses from the following sources. Tell me the correct option here, and then I will tell you the correct option with the correct explanation. Okay. I got it. Uh, you are talking about the foundation batch. 3 lessons are completed. Yeah, you have to follow this. This marathon will help you in learning the concepts which you will read in the upcoming classes. And basically in BFM there is two type of thing. One is related to the numericals and one is related to your concepts. So concepts are the same whatever you are reading here, and whatever you are on that courses, we are reading everything very deeply, and here I am revising, I am giving the revision of that concept, so you can follow. Don't this will be helpful for you. Obviously this will be helpful for you. Moving to the question answer. See, a bank may have foreign exchange surpluses, but from several sources, which includes profit from the overseas branch operations. See, a bank, this is a bank, with the foreign branches earns profit but in foreign currencies. Earns the profit but in the foreign currencies from the international operations. These profits are typically denominated in foreign exchange and contributes to the bank's foreign exchange surplus. If a bank wants to borrow foreign exchange from the international market, it can accumulate the foreign exchange surpluses. And this borrowings might involve issuing the foreign currency bonds or taking loans in the foreign currency, thereby increasing the bank's foreign currency holdings, foreign currency and the convertible rupee deposits with the branches. If we talk about the foreign currency deposits basically are made by the customers in the bank's foreign branches and through global accounts. Additionally, convertible rupee deposits, the deposits which are in the Indian rupees that are freely exchanged and can be freely exchanged with the foreign currencies, and these are contribute to the foreign bank's foreign exchange holdings. So we can say that here all the options are correct. Profit from the overseas branch operations, forex borrowings in the foreign domestic market, and also third one here is also correct, that is foreign currency and convertible rupee deposit with the branches. So here we can say that option 4 is correct, that is all. Next question. The foreign exchange market remained open on which of the following days in India? in India I am talking about, and you all know the answer of this: Monday to Friday. That means on weekends there is no foreign exchange markets are doing the buying and selling of currencies, because we know that in the foreign exchange markets buying and selling of currencies are happen. Okay, so only Monday to Friday these type of things are happening, and foreign exchange market operates from Monday to Friday. The market remain open during these days for trading currencies and other forex related activities. And also if we talk about the Saturday and Sunday market, this market is closed for trading, but some international markets may still operate during weekends in certain types of regions. Okay, and the forex market in India is open from Monday to Friday. Option C is correct here. The term open position of the dealer include D option is lost from here, but luckily correct option are from these three options. I don't know where the D options moved. Okay. So the term open positions of the dealer include C. Open position. What is the meaning of open position in the foreign exchange? It refers to the amount of a currency that a dealer holds that has not been offset by an opposite transactions. The term includes both overbought and overbought position. Means this occurs when a dealer has bought more of a currency than they need, anticipating that the value will rise. Essentially, the dealer is holding a long position in the currency. And we can say that here oversold position, this occurs when a dealer has sold more a currency that they own, which anticipating that the value will decrease. This is the short position, where a dealer has borrowed the currency and sold it. And both of these positions are considered part of the open positions because they represent exposures to a currency fluctuations until the positions is closed or hedged. So option A is correct. It includes both overbought and oversold positions. If you are liking this session, kindly give the like to this session, and any type of suggestions you also can give. It will also help me. According to me, I am thinking that nobody is perfect in this world. Maybe there are lot of problems in me and lot of problems in everyone, so we have to work on these problems to improve ourselves. So if you are feeling any type of query, any type of suggestion you want to give, you can give. Every type of appreciation, every type of suggestion, every type of thing is acceptable. I will try to work on that. And also if you liking the session, so just hit the thumbs up and give the like. And then we will move to the next question. Which of the following positions are maintained by a foreign exchange dealers in a forex dealing room? And I know that the time of examinations are very what is the correct word? I am not using, I am forgetting. Very complex days are those. And yes, already BFM is everything. Everyone is thinking that BFM is one of the toughest exam, one of the toughest subject. But no, everything is related to the international banking, risk management, treasury management, balance sheet management. That's it. So don't think that this is impossible, this is hard. Everything is possible in this world. Who is making these rules, whatever, who is the person who are established these concepts, they are also the persons. So we can tackle, we will achieve the target, don't worry. And I am waiting for that day when you will do message that I cleared my exam, that is the proudest moment for me. So tell me the answer of this question. Which of the following positions are maintained by a foreign exchange dealer in a forex dealer room? See, if we talk about the forex dealing room, a foreign exchange dealer typically maintains two types of positions. First one is funds position. Funds positions means these basically refers to the cash or the liquid assets which is available to the dealer for conducting the transactions, which includes managing the dealer's overall liquidity. It also reflects the balance of cash which is available for buying and selling the foreign currencies, and also the currency positions. This refers to the specific positions that held in various types of foreign currencies, and it shows whether the dealer is long, holds a currency with the expectations that the value will increase, or short basically holding a position that will benefit if the currency value fails or on the particular currencies. That is called currency position. So according to this, the correct option of this question is funds position and currency positions. So the option C is correct here. Next question. Next question is saying that part of the office of a dealer which takes care of processing of deals, accounts, reconciliation is called. I told you this thing that reconciliation is related to the back office, right? I am correct or I am wrong, you can tell. There is nothing to hesitate. There is nothing in giving the wrong answers. All other persons are living here for earning the profit. Obviously, everyone is here. Obviously, everyone, I am also here. I am teaching just for the profit, obviously. So everyone just give the answer. Try to make this class interactive, and with the smile, with the greatest smile, let's deal with this trouble, that is BFM, and try to tackle this trouble. So give the answer. I am giving you also the answer. Basically, in a foreign exchange dealing, let's talk about all the offices here. Let's talk about the front office. This is the part of the office where trading activities happens. Whatever the dealers are in the front office are responsible for making trades, managing the positions, and handling the client interactions. And if we talk about this back office basically handles the processing of deals, accounts, reconciliations, and other type of administrative functions. It ensures that all the transactions are accurately recorded, settled, and the reconciled. Now after listening this, your mind is saying that this option is correct. Yes, this option is correct. The back office basically plays a key role in ensuring compliance with regulations and maintaining the operational efficiency. And if we talk about this mid office, the mid office is responsible for risk management, monitoring, and ensuring that the risk exposure of the front office is in the line with the firm's risk management policies. It typically basically it typically does not engage in trading but act as an oversight and control function. And if we talk about this transaction process office, this is not standard form in the forex market and the related to the forex trading transactions. The correct term is here option B, that is back office. So whatever the things related to the processing of deals, accounts, reconciliation is called here back office. Deals by the back office. Now the next question, popular derivatives which is used in the foreign market includes forward contracts, options, swaps, forward rates, futures. Now it is okay that every option is given, so we will describe the option. This will help in brushing up our concept, not this brushing up, this brushing up. Okay. See, whatever the listed instruments are popular derivative which is used in the forex market. First one is forward contract. These are the agreements which are made between the two parties to buy or sell a currency. Sell a currency on a predetermined date on a specified future date. These are customizable and traded over the counter. Options, currency options are the buyer gives the buyer the right but not the obligation to buy or sell the currencies at a specified price or on before the certain date. These are also widely used in the forex market to hedge or speculate on the price movements. If we talk about the swaps, a currency swap involves the exchange of principal and the interest payments in the different currencies, which is used for hedging the interest rate risk or obtaining the foreign currency financing. And if we talk about this forward rate agreement, that is also called as FPA, these are the financial contracts which are happened between the two parties to exchange the amount of payments or basically amount of money at a future date, but it is based on the agreed upon interest rate. While not directly tied to the currency exchange, FPAs are related to the interest rate and are used in the forex markets as well. And if we talk about this futures, currency futures are the standardized contracts which are traded on the exchanges to buy or sell a currency but a specified rate and the specified rate and date. These are similar to the forward contract but are exchange traded and come with margin requirements. So we can say here all the options, forward contract, options, swap, forward rate agreements and the futures, all are used in foreign market. These are the popular derivatives. Understood? Moving forward, in a foreign exchange transaction, deal date is 8th of January 2022 and the settlement date is 12th of January 2022. I think 2022 is too late. Let's talk about 24. It is known as, let's tell me, 8th of January 2020 day. Settlement is on 12th January. See, in the foreign exchange transaction, This settlement date is refers to the date when the exchange of currencies actually takes place, and the deal date is when the trade is agreed upon. If we talk about the spot transactions, we know that these spot transactions have a settlement date that is business days 2 business days after the deal date, that is T plus 2. This is the most common settlement period for money currencies and for a lot of currencies pairs. And basically here the deal date is 8th of January, okay, and the settlement date is 12th of January. That means which is exactly 2 business days after the 8th of January. Saturday, Sunday not considered as the official business days because weekend is there. So the transaction is basically that settlement date is on 12th of January. This is called completely the spot settlement. Ready or cash, immediately, when the settlement happens immediately, typically on the same day or the next day. Tom means tomorrow. It is refers to the which is happening on the next business day. But the forward, in a forward transaction, the settlement date is more than the 2 business days after the deal date, which is typically used for hedging against any type of foreign currency transactions. Okay, so the here option C is correct. Okay, a resident of India who has gone out of India on a temporary visit may bring in India, and at the time of his return from any place outside India, but not Nepal, not Bhutan, currency notes of Government of India and Reserve Bank of India, notes here up to an amount not exceeding which of the following is the correct answer? So here, according to FEMA, Foreign Exchange Management Act, and the RBI, according to the guidelines of these, a resident who is the resident of India who has gone out on a temporary visit, here whatever the condition is saying, the amount is not exceeding more than 25,000. This limit applies to the currency notes on the Government of India and the Reserve Bank of India, and the limit is rupees 25,000 for the residents who are bringing the currency from the abroad, and limit is set by the RBI to prevent any type of money laundering and illegal activities. So the answer is rupees 25,000. These types of questions are direct, because in this only the whatever the guidelines is there, we have to apply the guidelines. How much foreign exchange can be brought in while visiting India? How much foreign exchange can be bought? According to me, the aggregate value of the foreign exchange which is brought in the foreign currency note, if they exceed the US dollar 2,50,000 or equivalent, it should be declared to the custom authorities in the airport, basically in the currency declaration form on arrival in India. But there is no type of limit. If you are coming in India and you are bringing the foreign exchange, that means the amount, if it exceeds this amount, you have to inform, but there is no limit. So here the answer is no limit. All remittances which is listed out in dash remittances, whether capital account transactions, current account transactions, or the combinations of both, termed as permissible transactions under LRS as per the FEMA 1999. See, if we talk about this FEMA, Foreign Exchange Management Act, the liberalized remittance schemes allows resident individuals, they can remit certain amount of money abroad for some permitted purposes. Okay, but for the both capital account transactions and also for the current account transactions. So basically, schedule 3rd of the FEMA regulations outlines the types of remittances that are permitted under the liberalized remittance scheme. This schedules basically list out the various types of permissible remittances. Basically, they are related to the current account transactions. What is this current account transaction? It includes the payments for travel or education, or the capital account transactions, which is like investing in abroad. So the remittances which are covered under the LRS scheme, whether capital or the current account transactions, are described in the schedule 3rd of the FEMA. So that means option 1 is correct. So with the help of this question, you revised capital account transaction, you revise the current account transaction, you revise what is the schedule here correct, and what is the meaning of liberalized remittance scheme, that is LRS. Now moving to the most important question, that the foreign currency account maintained by a bank with another bank are classified as nostro, vostro, loro, or none. So this is a type of rhythm here, nostro, vostro, loro. A song can be composed if we are using the correct, a good music, but we have to learn. Foreign currency account which is maintained by a bank with another bank are classified as, let's talk about basically these all, nostro, vostro, loro, we will describe all. Nostro account is a foreign currency account. This is a foreign currency account that a bank holds with another bank in a foreign country. Nostro means ours in Italian, and the bank holds the account in foreign currency for its own purposes. We can take the example here. If an Indian bank here, this Indian bank basically holds a US dollar account with the US bank, it is referred to as a nostro account for the Indian bank. But what is the vostro account? This account is the reverse of nostro account. It refers to the account that is held by the foreign bank with the domestic bank, and vostro is basically means yours, and it represents the foreign bank's account with the domestic bank. For example, if a US bank holds or Indian rupee account with an Indian bank, it is a vostro account for the Indian bank. But what is the meaning of loro account? Loro account refers to the account which is held by one bank or behalf of another bank. It is a third party account. It means theirs. It means theirs in the foreign bank account with the domestic bank. So here we can say the foreign currency account maintained by a bank with another bank are classified here as nostro. Nostro here is the correct answer. Understood? Swift has inbuilt security system with an automatic authentication of financial messages through and is available 24 hours a day and 365 days in a year. So Swift basically is what? Society for Worldwide International Society for Worldwide Interbank. Sorry for this. I think I need water. That's why I'm writing wrong. Society for Worldwide Interbank Financial Telecommunication. This is a global messaging network which is used by the financial institutions to send and receive the information about the financial transactions in a secure, standardized and the reliable environment. To ensure the security and the authenticity of the financial messages which are exchanged over the Swift and automatic authentication system is implemented through bilateral key exchange. This is basically is a process where two institutions are exchanging and securing the keys, which is known as sender and the receiver, to authenticate the messages sent between them. So this is the answer. Basically, this key ensures that financial messages are authenticated before they are processed, adding a layer of security here to the communication. And this Swift operates basically 24 hours a day, 365 days a year to facilitate the financial transactions across various types of time zones. Basically, this Swift have no holiday, no Diwali holiday, no winter vacation, no Eid holiday, no Holi holiday, no Christmas holiday. This Swift have to be work all the days and 24 into 7 in a day. Okay. Which of the following entities are not eligible to open and maintain SGL account with the RBI? So you just tell me the answer of this. Till then, I am going to drink the water. So please allow me to drink the water. So I am back because I have bottle in my table. I am not going anywhere. So, which of the following entities not eligible to maintain? But what is this SGL account? Let's talk. SGL account. This is an Securities General Ledger account. Basically, this is a type of account which is maintained by the RBI, which is primarily used for holding the government securities. It allows eligible entities to hold and settle the transactions which involves government securities and the treasury bills. So if we talk about the correct answer, central government is not allowed to central government is eligible to open and maintain an SGL account. Insurance companies are eligible to open and maintain SGL accounts, and corporate and LLPs, partnerships, these are not allowed to open any type of SGL account with the RBI. So this option is correct here. That is option D, corporate and the LLPs, limited liability partnerships. Okay. Next question. Oh, very big question. But yeah. Many factor causes or events which affects the basic economy and monetary policy of the concerned government. The causes normally affect the long-term exchange rates, while in the short run, many of these have less effect. What are the long region factor? Okay. Now, let's see the answer of this question. See, here all the listed factors, all the given options are the example of long-term factors that can affect the exchange rates. They basically influence the underlying economic health of a country, which is in turn affects the demand for its currency. If we talk about the surplus, a country with a surplus a country with a surplus in its BOP, balance of payments, is likely to have a strong currency. This is because a surplus indicates that the currency is exporting more than it imports, which leads to the higher demand for its currency. Then deficit. Deficit means a country with a deficit in its BOP is likely to have a weak currency. This is because a deficit indicates that the currency is importing more than it exports, which leads to the lower demand for its currency. Then economic growth rate, high growth, a high economic growth rate often leads to the strong currency. This is because a growing economy attracts the foreign investments, which leads to an increased demand for the country's currency. So here all the options are correct here. Tight monetary policy means this policy which involves increasing the interest rates to reduce the inflation and slow down the economic growth, and it can lead to the stronger currency in the short term, and it attracts the foreign investment. So the option here, all the factors are correct here. Long reason factors, all the factors are correct. So the options basically, just lets me, I think these in this one thing is missing, that like only one option is correct means just think all the options are correct here. One thing is missing. I don't know how uncareful I am. I missed this thing. Okay, just ignore. All the options are correct here. Okay, all the factors are correct there. Next question. Who has advised that the board of director of bank should frame an appropriate policy and fix suitable limits for its forex dealing operations for the management and control of a dealing room? who can advise the board of director? Just think, RBI. RBI have that power, who can advise the board of directors. So yeah, that Reserve Bank of India is the regulatory authority for the banking operations in the India and provides the guidelines for the various aspects of the Forex dealings. Specifically, this RBI advises the board of director of banks that they should have framed the appropriate policies and establishes the suitable limits for managing and controlling the foreign exchange dealings in the bank's dealing room. So the correct answer is RBI. And you know that FEDAI is Foreign Exchange Dealer Association of India. It is a body that assists with setting guidelines and the code of conduct for foreign exchange dealings and the transactions. IBI is our Indian Banks Association. It is also a representative body of banks in India, but it does not issue in this all that thing, issuing the advices to the board of director. So the correct answer is RBI. A person may bring from Nepal and Bhutan currency notes of government to India, and the RBI of India notes in denomination not exceeding, as per the guidelines of the RBI and the Foreign Exchange Management Act, a person who is coming into India from Nepal or Bhutan may bring currency notes of Government of India and the Reserve Bank of India in denominations, but not exceeding this 100 rupees. This limit specifically applies to the currency note, and it is a part of regulatory framework which are governing the cross border movement of currency between India and its neighboring country, that is Nepal or Bhutan. So the correct answer is option 2, that is 100. Okay, understood? Once again, if you liking this session, kindly give the like to the session channel. You can subscribe to the channel and also press that bell icon. Now, annual performance report to be submitted to the dash through the designated AD bank within every 31st year on the performance of the overseas entity where investments are made by the Indian party. See, as per the guidelines which are provided by the RBI, under the FEMA, an Indian party that has made investment in overseas entities is required to submit an annual performance report. This report provides details on the performance of the foreign investment which is made by the Indian party. This APR must be submitted through the designated authorized dealer bank to the RBI. This report is due by 31st July every year, and it includes the important information about the financial performance. So the correct answer is option 3, that is RBI. Now the questions without options. Yeah, it is a SWIFT code that is used for issue of a documentary credit. See, in SWIFT messaging, the correct code here, that is MT700. Yes, in SWIFT messaging, different messages types are used for various types of banking and the financial services. This MT700 message type is specifically used for a issue of a documentary credit. This message is sent by a bank to another bank, and this MT700 is used to establish the terms and conditions of the documentary credit, and it includes the detailed information such as applicant, beneficiary, amount and the expiry date. So the SWIFT message which is used for issuing a documentary credit is MT700. Okay. Okay. Don't angry. Just okay. Everything is good. That camera is like shaking like that. Shaking like that. That camera is not liking the question. That's why I'm saying don't agree. I know you are doing hard work, but you have to do. Okay, it is a SWIFT code which is used for the general financial institution transfer, means the money under LC, letter of credit, is transferred using which code I am talking about? So here I am talking about the MT202. This is basically message type in the SWIFT system which is used for the transfer of funds between financial institutions. It is typically used to transfer the money in cases where payments are made under or related to the documentary credit or other type of financial transactions. This MT202 is used for some type of general interbank transfers, meaning like it is used when one bank sends the funds to another, which could be part of the payment under the LC. Basically, this SWIFT message is used to settle the payments between the financial institutions and also does not contain the same detailed trade specific information. In the context of LCs, once the terms are agreed and goods are shipped, this MT202 is used to transfer the money between the bank of the buyer and the seller. So the correct answer is here MT202. Understood? Next question. If any issues between the parties of LCs that they can approach to dash for its resolution, where they are going to solve the things. So obviously they will go to the doc decks. What is this doc decks? This is the documentary credit export system. This is a dispute resolution mechanism which is used to resolve issues which are related to the LCs. It is a system which is deployed by the International Chamber of Commerce, that is ICC, to provide quick, efficient and the expert-driven resolutions to disputes which are related to the documentary credits, which includes the issues which are surrounding by the credits and also the interpretation of the terms of the LC and all the discrepancies in the documents or the non-compliance with the terms of the credit. Okay, so the answer is here doc decks. Where banks do not have their own system of rating of currencies, they adopt the country risk rating of ECGC. ECGC groups countries into how many categories, which is based upon country risk classification. I think let's talk about this ECGC, that is Export Credit Guarantee Corporation of India, which is an institution under the Ministry of Commerce and Industry, which basically provides the country risk ratings to help the banks and the financial institutions across the India. Okay, and basically these types of ratings helps in determining the level of risk which are associated with offering credit, particularly in international trade. There are 7 types of categories which are based on the level from low risk countries to high risk countries. First one is category 1, that is related to the low risk. 2, moderate risk. Third is medium risk. Then high risk, very high risk, extremely high risk, special category. Countries where the war or political instability is prevalent. So the answer is 7 categories. So the next question, you are in your screen, that's why I hide myself, so you will properly see the question. And also I will tell you the secret, I have the watch of Mr. India, so whenever I want I can hide myself. And yes, please, if you like this session, kindly give the like to this session and try to tell me which option is correct here. Basically, I am giving you the hint. Whatever the Indian banks which are using the standardized approach, specifically maturity method, to calculate the capital charge for the market risk. Okay, for the market risk, this method is simpler and less complex than the internal models approach, and also it is making suitable for most Indian banks. This maturity method relies on the maturity of the underlying assets to calculate the sensitivity of the portfolio to interest rate charges. So the correct option is that the maturity method of the standardized approach, which is utilized by the Indian banks to compute the capital charge for the market risk. So the option B is correct here. Understood? Next question. I think I have to hide again myself. Okay. Following exports shipments out of India are exempted from the export declaration form in terms of the cases which is indicated in the Regulation 4 of Foreign Exchange Management. Which of the following exempted is not true? See, after reading all the statements, basically these types of export might require specific custom procedures and also the documentation, because generally it does not exempt the exporter from filling the EDF. What is EDF? Most important form, that is export declaration form. This specific requirement would depend what is the value of the good, what is the nature of the repair, and all other relevant factor. Basically, which option that is not correct, that is aircraft or the aircraft and the aircraft engines or the spare parts for overhauling and repairs which are subject to the re-import into India after overhauling repairs, we can say, within a period of 3 months from the date of their export. So basically other options are correct and also represent the common exemptions from the EDF requirement. Some common exemptions are trade samples and publicity material sent free, personal belongings of the travelers, goods supplied to the or government agencies or the military, good important duty free from re-export. So basically here the correct option is option 4. Now Mr. Rohit wants the branch manager to explain all the forward contract facilities available in NRIs. So basically what is the meaning of NRIs? Non-resident Indians. They can enter into the forward contracts. They can enter into the forward contracts with the authorized dealers to hedging the various types of foreign exchange exposures. First one is the amount of dividend which is due to the NRIs on shares which is held in an Indian company. Basically here NRIs can enter into forward contracts to hedge the foreign exchange risk which is related to the dividends. They also receive on shares which is held in Indian companies, and the balances which is held in FCNR or NRE account with the rupee as one of the legs. Basically forward contract can be used to manage foreign exchange risk which are associated with balances, whatever the balances in the FCNR risk, which is basically foreign currency non-resident, and NRE is non-resident exposure account, particularly when the rupee is one of the currencies involved. But if we talk about the correct answer, all the options are correct here. All the option cross currency forward contract, because NRIs can book cross currency forward contracts to convert the balances in one foreign currency and also into another foreign currency. So here we can say all the options are correct here. So if Mr. Rohit wants the branch manager to explain all the forward contract facilities, these all the things are available. Okay, understood. Next question. Yeah, liberalized remittance scheme is here available to, I think that is the easiest question. This is available to the minor, because this liberalized remittance scheme under the RBI allows Indian residents to submit a certain amount of money abroad, but for the various types of purposes. Under LRS, the remittance limit is $250,000 per financial year. Financial year is to April to March, but however there are certain restrictions who can use the LRS. Minors are allowed to remit under the LRS but the remittance must be made by their guardian or guardian on their behalf. But corporate, partnership firms, HUFs, trust, they are not allowed. HUFs, Hindu Undivided Family, which are not eligible by the LRS, and this scheme is meant specifically for the individual resident. So the correct answer is option E, that is minor. What are the prohibited items under the LRS? Those question is little bit big, so I have to hide myself. Let's tell me what are which activities are not allowed by the LRS. See, if we talk about the first option, remittances from the India for margins or margin calls, these activities are prohibited because it includes some type of speculative transactions or trading in the financial market abroad. Remittances from purchase of FCCB issued by the Indian companies in the Indian secondary market, this is also not allowed. Basically, that does not allow remittances for investing in the foreign currency convertible bond in the overseas secondary market. This is also considered as capital market speculation. Third option, it is also not allowed. because it is also considered as speculative activity. If we are talking about the fourth option, this is also not allowed, because the remittances which are remittances to those countries which are identified by the FATF as non-cooperative are prohibited during the concerns over money laundering and other any type of illegal activity. So we can say option D is also correct. Understood? Next question. Every important must have an dash code which is used by the DGFT. Okay, which code? This is a unique code. Every important must have an IEC code. IEC, import exporter code, which is issued by the DGFT. DGFT is Directorate General of Foreign Trade. This IEC is mandatory requirement for any type of business, any type of individual who are wants to import goods into the India. It is basically a 10 digit unique code that is used to track and regulate the imports and exports in the country. The IEC is essential for clearing the shipments through customs or facilitating trade with the foreign countries. The remittances against import should be completed not later than dash months from the date of shipment. I think the answer is 6 months. According to the guidelines of the RBI and the Foreign Exchange Management Act, the payment for imports must be made within 6 months from the date of shipment. This period allows the importer sufficient time to complete all the transactions. Basically, in this, it ensures the payment is made for the goods imported. If the payment is not made within its time frame, the transactions may be flagged for non-compliance with foreign exchange regulations. Advance remittance for imports can be allowed up to US dollar 2 lakh, I think 2 lakh, yes, without insisting on guarantee of the international bank. Basically, RBI allows advance remittances for imports without a bank guarantee up to US dollar 2 lakh. However, there are specific conditions and the guidelines which need to be followed. Okay. Next question. In the case of advance remittances for the commodities, physical imports should be made within, answer is again 6 months, because whatever the physical import for advances, remittances or the commodities should be made within 6 months from the date of remittance. Any advance remittance, any type of advance remittance for the imports is a financial arrangement where an importer sends the money in advance and also sends the money advance to the foreign supplier before receiving the good. This is often done to secure the supplies and also expediting the production or comply with the specific supplier terms. Moving to the next question. Just sharing the next question. Just give the answer till then. Okay. And also one more thing, join the PDF, join the Telegram channel for the PDF, and the link for the Telegram channel is in the description box. You can join this group for all the updates, all the PDFs. So kindly join the group Telegram channel, that is Telegram channel, and also where you get all the PDFs, and try to give the like to this session. Okay, so the question is saying here, and as an evidence of having made the import, the importer has to submit bill of entry duly, which is approved by the customs to the AD. Basically, this bill of entry is a legal document which is required by the customs authorities when importing goods in India. It serves as a proof that the goods have been cleared by the customs, and it is used to ensure that the necessary duties and taxes have been paid. The document must be submitted to the authorized dealer, such as a bank, to confirm the completion of the import process for the payment or the remittance purposes. Moving to the next question here, IEC is required for. IEC, I already told you, importer exporter code, 10-digit unique code, which is a mandatory requirement for any type of entity, whatever, for the individuals, for the firms, for the company. And also it is wishing to engage in export or import activity. It is issued by the DGFT. So here we can say that undertaking any type of export or import transaction. Which of the following statement is correct? See, let's talk about the first statement. Export to Nepal are to be paid through ACU mechanism. If we talk about this export to Nepal are to be paid through ACU mechanism. The ACU mechanism is what? Asian Clearing Union. It is a mechanism which is used for the payment between the member countries for the transactions, but in specific foreign currencies. Nepal are usually settled through normal banking channels. So status here, basically we can say that this statement is incorrect. Let's talk about the second statement. Status account holders are allowed to retain 100% of the eligible credit which is received in EEFC account. Under the Exchange Earners Foreign Currency Account scheme, status holders are allowed to retain that 100% of their eligible foreign exchange earnings in the EEFC account without converting into Indian rupees. So this statement is correct. Okay. Third statement is given here. Basically that is export bills. Export bill is basically financing is known as PCL. This statement is also incorrect. We know that PCL stands for the pricing credit limit, which refers to the short-term financing which is extended to exporters to meet the working capital requirement for producing or packing goods for the export. So this statement is also incorrect. And if we talk about the fourth statement, at present bank are here allowed to charge interest on PCFC for 180 days at a maximum of LIBOR plus 1.00%. This statement is also incorrect. Why? At present, banks are allowed to charge the interest on PCFC for 180 80 days at a maximum LIBOR plus 1.00. Basically, if the export which is does not takes place, the packing credit advance is generally treated as NPA or regular loan, not as export credit. So only the second statement is correct here. Okay. Next question. Dash credit is credit which is directly extended by the overseas suppliers of goods to the importer. So suppliers credit. Why? Because this supplier's credit refers to the credit which is extended directly by the overseas suppliers of goods to the importer. This means basically that the supplier of the goods allows to importer to delay payment for a specific period rather than requiring the immediate payment at the time of shipment. So supplier's credit is the credit. That is the correct answer here. As per the guidelines, RBI guidelines, any credit up to period of less than 3 years is called trade credit. Trade credit which is refers to the short term financing which is provided by the supplier or the other parties for the purchase of goods or services, usually with the repayment period of less than 3 years. Okay, and ECB's external commercial borrowings, it is basically type of a loan or the borrowings which is taken by the Indian companies from the external sources with a maturity period of 3 years or more. Okay, next question. You are doing this question, till then I need 1 minute for water. So kindly allow me for 1 minute. Okay, done. Now, banks which can approve proposals for the availing buyer credit for a period within a maturity up to 1 year for import all types of items which are permissible under the foreign trade policy up to $20 million per import transactions. Banks can approve the proposals for availing the buyer's credit with a maturity period up to 1 year and for the import all types of permissible under the FTPs. The amount of buyer's credit can up to $20 million per import transactions. Okay, and if we talk about the buyer's credit, it is a form of short-term financing which is provided by a bank to a importer to pay for goods which is imported into a country typically for up to 1 year under the prescribed conditions. Next question. Small exporter policies is basically the standard policy which are incorporating certain improvements in the terms of cover in order to encourage small exporters to obtain and operate the policy. It is issued to exporters whose anticipated export turnover for the period of 1 year does not exceed. The direct answer is 5 crores. And this SCP, small exporter policy, is especially designed to encourage the small exporters by offering enhanced coverage and the benefits. It is basically issued to the exporters whose anticipated annual export turnover does not exceed 5 crore. Okay. Bill of entry is required. Why bill of entry is required? I already told you what is the meaning of bill of entry. That is required the goods that have come into the country of import. That's why we need bill of entry. Oh. What is the ICC in the case of global trade? ICC is International Chamber of Commerce. It is a global trade body which basically governs and sets the rules for various types of trade instruments, which includes also the UCPDC, which is a set of internationally recognized rules for letter of credit. Okay. So the correct answer is here option B, the trade governing body, the trade body governing the UCPDC rules. UCPDC 600 is basically a set of rules which is framed by the ICC, governing LC business globally. So the option C is correct here. But what is the explanation? Okay, we'll tell you. Okay. UCPDC 600. It is a uniform customs and the practices for the documentary credits, and it is the 600 edition. It is the internationally recognized rules which is governs the use of letter of credit in the global trade. Okay, and ICC are widely accepted by the banks, exporters and the importers worldwide. The Incoterms, which confirms that the price of the goods is inclusive of insurance and freight up to the port of destination, is called. The correct answer is here CIF, because CIF is cost, insurance and freight. Basically, these are the Incoterms that indicates the prices of goods, which includes not only the cost of the goods and the freight charges, but also the cost of insurance for the goods while they are being transported to the port of destination. This CIF means the seller is responsible for paying the cost associated with the shipment, insurance and freight up to the destination port. Then this CNF is, which is an older term, only includes the cost of goods and freight charges but does not cover any type of insurance. This CPT, this is carriage paid to, which means covers the transportation cost to a named destination, but insurance is not included. Okay. How does the importer banks make a payment to an overseas supplier in a case of site LC? If we talk about the site LC, the importer banks makes a payment to the overseas supplier when the supplier presents the required documents such as bill of lading, commercial invoice and the documents which are comply with the terms of LCs. This payment is typically made by remitting funds to the Nostro account. The transfer is often done by the SWIFT MT202, which is a standardized message format used for international banks transfer. So we can say here the correct answer is option B. Understood? Go. Okay. I think next question. Which of the following statement is correct? Which of the following statement is correct? You can read every every statement here. Then we will discuss every one by one. If we talk about the first one, NRIs can acquire share or property by war of inheritance from a person resident outside India. This is correct. Why? Because NRIs are allowed to inherit the shares or property from a person who is resident outside India. Let's talk about the second. NRIs cannot acquire shares on repatriable basis. This is incorrect. NRIs can acquire shares on a repatriate basis, but only under some type of specific conditions. NRI cannot invest in any type of partnership forms or owner partner. This statement is also incorrect. NRIs can invest in a partnership firm in India, but only if the firm is engaged in the activities that are permissible for the NRIs under FEMA regulations. Okay, and the fourth statement is saying here, NRIs can acquire the property by purchase out balance held in the NRI accounts. This one is correct because NRIs can acquire the property in India. Yeah, through funds that are held their non-resident external accounts as long as the property is residential or commercial. Then banks can permit repatriation of sales proceeds of house property held in NRO account up to $1 million per year. This is also correct because as per the RBI guidelines, NRIs can repatriate up to $1 million per financial year from the sales proceeds of a house property. So basically here, which one is correct? Only I think 1, 4, 5 is correct. Yes, 1, 4 and 5 is correct. Understood? Only 1, 4 and 5 is correct here. Next question. And also, if you are liking this session, kindly give the like to the session. Okay, let's discuss this question. Under the interest subvention on export credit scheme, which of the following sector is eligible for 2% interest subvention on rupee export credit? Which sector is that? Handicraft. Under the intervention subvention on credit export credit scheme, certain sectors are eligible for a 2% interest subvention on a rupee export credit to make their exports more competitive. The handcraft sector is one of the sectors which is eligible for the scheme as it is considered as a labor intensive and an export oriented sector, which is which is very important for promoting India's export growth. So which of the following is required? Where is an individual required to submit the CDF to custom authorities on arrival in India? Tell me that. Then I think 6-7 questions are only left in this. Important questions I take. Okay, so if we talk about the RBI and the custom regulations, currency declaration form CDF must be submitted by an individual on arrival in India if the aggregate value of foreign exchange basically includes both foreign currency and traveler's check, which is exceeds $10,000 or its equivalent. So the option B is correct here. Okay, understood? This question is done, repeated by me. Sorry for this. Yeah, this question. Foreign exchange markets does not include. You can tell the answer here, which does not include. Just tell me this answer. See, let me tell you here the correct answer. If we talk about here, the foreign exchange which does not include the instruments that are drawn in Indian rupees on a current account of an Indian company here, basically of an Indian company payable in India. This option involves the transactions in the Indian rupees, which is a domestic currency, and foreign exchange typically involves the currencies which are other than the domestic currencies of a country, and the other options involves foreign currencies or the transactions that are payable in the foreign currencies. So option D is correct here. Now, out of the several factors, this is also repeated, done. Political instability is the answer. This is also repeated. Sorry for this. Yeah, bid rate, we already, sorry, selling the currency, that means offer rate, done already. Operational risk. Now, let me tell about the operational risk. Operational risk is done when there is issues related to the humans. When the humans do the errors and any type of external events such as natural disasters which are beyond the control of the bank, then in that type of cases operational risk is occurs. So the correct answer is here movement in exchange rates, because this is related to the foreign exchange risk. Okay, so the correct answer is here movement in exchange rates. Crystallization of export bills is to be done. Crystallization of export bill is to be done. What is the meaning of this crystallization of export bills? This is a process. Basically, banks transfers the exchange rate risk back to the exporter. This typically happens before the due date of the bill to mitigate the potential losses due to the currency fluctuations. So we can say the answer is before the due date. Which of the following is an FATF compliant country? The answer is Pakistan. But what is the meaning of FATF compliant country? Pakistan has made efforts to comply with the Financial Action Task Force, that is FATF, although it has faced challenges and the security. So we can say this is the correct answer. Okay. Form 1 refers to? Form 1 is especially designed for outward remittances which do not relate to the imports. This includes a variety of transactions such as payment for services, investments, donations, payments for the educational purposes, other permissible transactions under FEMA. So the correct answer is control from outward remittances other than imports. The resident individuals having invested in the overseas subsidiary should be allotted shares within a period of 180 days, because I think RBI here uh, issued the guidelines that a resident individual who has invested in overseas subsidiary must be allotted share with a maximum period of 180 days from the date of receipt of the inward remittance or the date of debiting to the NREFC and SCNRB account. Permissible ceiling for a resident individual making investment made under out of balances in the RFC account. If the case is RFC account, that this will be $5 million. Basically, these RFC accounts are special accounts which allows Indian residents to hold the foreign currency. They can be used to manage the funds from abroad, such as income earned in foreign countries or gifts. Correspondent do not include the account maintenance. Because in this is an arrangement where two banks typically located in different countries, and they are agree to provide banking services to each other customers. And also, while it includes some types of services like account maintenance and also authentication, but it does not involve opening a branch on behalf of a bank. Just wait. Correspondent banking is not related to the opening a branch. Yeah, I am wronging, because account maintenance is a part of correspondent banking. So option B is correct. Or let me tell that in the comment section that I am right or wrong. Okay. Loro account, their account with the third bank. Loro means basically a account held by a bank with another bank for the benefit of a third bank. So we can say the correct answer is option D. SWIFT, I already told you, it is a system to transmit financial messages between the banks globally. So answer B is correct here. And as per FEMA, a non-resident is a person who is working in Dubai for the last 3 years. Why this is the correct answer? Because under FEMA, a NRI is typically defined to an individual who resides the outside India for a specified duration, usually not residing in India for more than 182 days during the preceding financial year, and not residing for more than 60 days in the current financial year, or 365 days in the last 4 years, which is combined, we can say. An NRI cannot open the following accounts in India. NRI can't open which account in India? I think FCNR deposit in Australian dollars for period of more than 2 years. This is the correct answer. Because these types of accounts can be held in certain designated currencies, and the minimum tenure for FCNR deposit is typically 1 year, and this can be maintained for up to 5 years. This one is, yes, back-to-back LC. Tell me about the back-to-back LC. Back-to-back LCs are basically these types of letter of credit in which LCs are opened based on another LC. Typically, an export uses a export LC received from a buyer to open a second LC in favor of a supplier. So we can say that here the correct option is option C, that is LC opened on the backing of an export LC. This is done, this is done. Okay, in a LC, following parties are not involved. I think exporter is important in an LC transaction, and also the issuing bank is also important in the LC transaction. Advising bank is also there. Only the opening bank representative office in the beneficiary country who helps in sources business for the issuing bank. So this option is correct here. Bill of entry, this question is done by us. The goods that come into the country of import. Incoterm, this is also done. These questions are repeating. Okay, so I think the PPTs started repeating. Let me check this. Every question, according to me, every related question we have done today. And yes, if anything is left in this, any important thing, basically I try to cover all the MCQs of reliable sources and all the things here. I try to cover all the things in this class. But yes, if anything is left, I will definitely cover in the upcoming marathon session. Tomorrow we are having our module B marathon session. In that session also we cover all the important MCQs which are related to the risk management. And then next day we are having module C marathon, that is on treasury management. We will cover all the important MCQs, and we will try Macmillan's MCQs and some also other MCQs apart from the Macmillan. And then next day we are having module D marathon, and then we are having final marathon in which we will cover all the things related to our module A, module B, module C and module D. So I am hoping that today's session is helpful for you. If you like today's session, kindly give the like, and also any type of suggestion is also appreciable. Thank you so much for attending this session for that much time, and we will meet again tomorrow with new concepts, new module at the same time. Till then, everyone, take care and all the very best for your upcoming examination. I wish all of you will clear all of your obstacles. Thank you so much, everyone. Kindly subscribe to this channel, as this channel is new and is completely made for you. Thank you, everyone. Thank you so much. Good night and thank you. We will meet again tomorrow. Till then, take care, everyone.